Hello, friends. How are you doing? So happy to see you again. Now we are going to start one more topic that's called funds flow statement. Actually, it assumes very important place in the financial management, and not only that from the company's point of view, because it reveals the funds movement nature. Okay, it's very important. So that's why I just decided to take this class, funds flow statement. Before we get into, there are two, three parts I've divided into two, three categories. But finally, I will not end up only with preparing the funds flow statement. I will have to teach you how to read it. It's more important. As a banker, I have read so many companies' funds flow statement. So it's very important. So before that, there are some steps involved in preparing the statement. Before that, what is fund? Actually, what is fund? Fund is cash or cash equivalent. Simply you take this cash or cash equivalent. So otherwise you can otherwise you call this total financial resources of a company. Okay, this is very important. So the funds is as I told you, working. Somebody call it maybe working capital, the funds that's put to work and how it moves, etc. So naturally, you see, do you have funds? You ask the friends, do you have funds in your bank? Do you have funds in your bank account? Like that, you ask, no, this is money, cash or cash equivalent. So this year, you will try to find out how the company is just performing, how the movement takes place in the company. Funds very important because funds is the lifeblood of business. Very important. Without funds, you can't run. So a simple thing, as simple as that. So it's very important how the funds are being moved. So you need actually funds flow. Flow means it is not in one place. If it is there, it is not a flow. The water flows. They say water flows. Water flows means from one place to another, either this way or that way. The same way, the funds flow. Now the funds are moving inside or moving outside. Okay, so very important. So whether it is good for the company or it's bad for the company. So then finally the statement will reveal how it moves, whether it's good for the company or bad for the company. So that's very important. The financial health of the company is judged in this case. Very important. So the funds movement. So why we should take this funds flow? Between the two period, between the one period, the 12 months, let us say. So that means we need a previous balance sheet, and the this year's balance sheet. So previous balance sheet will form opening balance, and then the closing balance in the balance sheet. So the two periods, the two dates figures given, then you will have to find out. So it is between one end to the other end, one balance sheet to another balance sheet. What is balance sheet? Balance sheet is a statement of assets and liabilities on a particular date. It reveals on the particular date what is the position of the company. How many assets are there, what is the value, how many liabilities are there, what is the capital they brought in, etc. And at the time of the next year closing balance, again the balance depicted by balance sheet, they list out what are the items, assets and liabilities on a particular date. Profit and loss account will reveal the profits. Okay. The funds flow will reveal the movement of funds from one period, from one end to the other end. So you can say like this. So one end is you have to find out the position, the last year balance sheet. Then this year end, this year balance sheet. So these two. So between these two, how the funds are being moving, and whether it's good for the company, bad for the company. Why we should have this funds flow? Because see, we suppose I put my capital in the account. I'm a partnership concern. I put my 50 lakhs in that company. I want to know. I want to know. So supposing when you have adequate capital, why you are raising funds? Okay. See, like some of the questions you get now. Some of the questions you get naturally. So when you are losing, when you are incurring a loss, how you can pay dividend to your investors? Then where the money came from? The question just comes where the money comes and how it goes. Simple thing. So it's very important. So it reveals the financial structure of the company. Financial structure now it comes with the risk perception, risk. Risk is very important. So if when earning is slow, when your earning is coming down, okay, when earning is coming down, they will ask, how do you fund your working capital? How do you buy current assets? How do you buy stocks? Who has lent it to you? Okay, like that, it is asking. Then, how your capital expenditure, how you bought the machinery, from whom you taken the loan, what is the interest rate, how you can pay, how you are paying it. The question comes now. Naturally, you see some of things I sort of, where did the profit go in working capital finance? Where did the profit? Where the profit had gone? Where the profit had gone? Like those years, there is increase in working capital finance. If there is increase in working capital financed, when earning, how working increases working capital financed. The working capital, because you also go every day, you are increasing your targets, sales, production, etc. So naturally, current assets level will go up. So naturally, finance will go up. I told you, no, working capital. I already told you. When working capital, when you are expanding, when you are going for the higher sales, naturally working capital will go on increasing. Then it has to be financed by you, either by your own money or from others. Okay, so bank is always ready to give enhancement. Bank will give enhancement. Okay, instead of 5 lakhs, you take 8 lakhs, depending upon the projected sales or projected production, etc. So they will give the judge whether you will be able to achieve it, whether you have the market, whether you have the production capacity, etc. So many things are there. Other things being equal, other things are okay, taken care of. Then when there is increase in working capital, how it was financed, who has financed? So you have to buy more working capital, more stocks, no stocks. So you go with finance. Then when the earnings are increasing, when your earning is increasing, why your NW means, always remember, it is your margin money in the working capital. Simple. It is your margin money. Your margin money, why it is declining? Then why you are taking your margin money? You must be, you are putting your hand on the working capital, network capital. You are taking your margin money away from the system. When earnings are going up, naturally margin and the working capital will also go up. You will put more money now. So like that. So if how additional capital expenditure finance, how machinery was financed, who has given the loan where, what are the terms, how much interest you have to pay, like that. Very important. So then what is the projection, how much of a projection has increased, why you have made this machinery, the additional machinery. So what is the projection increase in your sales, how are you going to achieve the production, where is the market, are you having any orders on hand, etc. All these things to be the same, because otherwise, see, everything is a cost. I already told you in some of the sessions, everything is a cost. Nothing is free in the business. You have to be very, very smart. So like that also. So mix of bonus funds versus Excel funds. How many what is your contribution? What is others' money? But how much loans are there? If loans are more, then risk is more. Then I may not get back my money back if I put my money. So all these things we've seen. This is called very leverage impact. How it was possible to pay dividend? So when your profit is declining, how you can maintain the same dividend every year? Then who has financed? Where did you borrow? Naturally, you would have borrowed. When your income is low, but you are maintaining the same dividend every year, then somebody must have funded your dividend also. Now, what is the terms? Like that, so many things are there. So like this, how debt was repaid, how your debt was repaid. You cannot, some people are borrowing another debt to repay one debt. That is very dangerous. That's very dangerous. So then what is the thing? Why it's not going in the right direction? Why the cash flow is not coming in the business? What is the projection? What is the profit cash flow? What is the cash flow profit? What is the cash profit? Why is declining? Then the cash flow is declining, then internal accrual is declining, then your fund, there will be fund shortage is there, then you have to borrow from others. Again, interest is there. Again, risk is going up. Who will give you stock? Who will give you stock on credit? So things are like this. So that's why the funds flow is very important. That's why I'm talking so much and taking so much of time to introduce this. Very important, because funds flow. Like that also, if adequate depreciation provision is made, already your provision, you are providing for your depreciation, then why was loan raised? Why you bought the loan? When you are just accumulating some amount toward depreciation, By the time they come to an end, the life of the business come to an end, the depreciation, the provision that you have kept aloof should be taken care of, with which you have to purchase the thing. But in spite of that, why you are taking loan? Then that means that what you have kept for depreciation, you have been taken out. So like this, so many questions will come. I'm telling you, this is very important. So then the flow of movements, flow of funds takes place between two categories only. As already I told you, there is current assets. I already told you what is current asset. You in my last previous sessions, if you've seen under working capital management, I've already listed out what is current or what is non-current asset. So current asset is one which can be converted into cash within one operating cycle within a period of 1 year. So current liabilities are one which can be repaid within a period of 1 year only. It is not a long-term loan. It is all short-term to produce goods to effect the sales. So this is so current asset we buy. We buy the stock to sell. We buy the stock to produce. So how it is being funded? It is being funded from my money, from others' money. It's clear, very clear. It is funded by me, my own margin, that is called NWC. I already told you, NWC is not a big thing. I'm telling you, NWC means your margin. Please understand. People will say like that, current assets minus current liability, nothing but your money. Got the point? Your money may be your money, or maybe you're taking a term loan to build up the margin also. Sometimes banks are giving to build up current assets so that it is introduced as a margin also. That exceptionally banks are sanctioning also. So that is a NWC. So these current liabilities and current assets are one category or one group. Then other than these two are non-current assets and non-current liabilities. There are two groups are there. One group is current accounts. Current account in the sense current liabilities, current assets. Okay, current assets and current liabilities. And the other group is non-current assets, non-current liabilities plus equity plus your owner's funds. So this category. These two categories. If funds flow takes place, if there is a transaction takes place within this group, there is no flow of funds. It is only circulating air itself. It will not affect your financial structure of the assets and liabilities. Okay, very important. Then similarly, if there is a movement between non-current assets, what non-current? Building, non-current assets. Okay, building, non-current assets. Then machinery, non-current assets. Got the point? Here, current assets means what do you have classified? Stocks, book debts, prepaid expenses, etc. What are current liabilities? Bills payable, sundry creditors, bank cash credit, etc. So all the things are coming. The transaction is taking place within this group B. There is no flow of funds because there is no flow here. It is circulating air itself. It will not any impact on the funds flow. On the other hand, similarly, if there is a transaction between these two assets, non-current assets and non-current liabilities, there is no flow of funds. It is all circulating like a water, air itself. The water has to flow. So if there's a transaction between the group A and group B to group A, then only there's flow of funds. Depending upon the transactions, it may be inflow, it may be outflow. Got the point? Don't confuse yourself. First, classify what is current assets, what is not current assets. Current assets already told you, current liability already told you. It is all short-term category. So it is within the one group. Other group is non-current assets, non-current liabilities plus your equity. Equity means your capital. Okay, all these things are fine in place. If the transaction is taking place between group A, there is no flow of funds. It is just, but water will not flow. Water has to flow out. Water has to flow in. So it is, if there, it is like it is circulating in the air, so there is no flow of funds. Similarly, if there is a transaction between these two, group A itself, there is no flow of funds, only this circulating inside. No, it will not affect your financial structure. For example, for current assets, okay, we got some cash is there, 10,000 rupees cash is there. Now you are paid with the 10,000, you are paid the syndicators 10,000. Okay, syndicators 10,000. The impact is nil. Year reduced, year reduced. Got the point? On the other hand, just try to follow me closely. Just don't, if it's confusing, just drop it. If you're not able to do it, just drop it. No issue. Supposing cash is current asset or not? Cash is a current asset. Okay. Now you are running a business. You are running a business. Then you are fixed your daughter's marriage. You need money. Your personal account, money is not sufficient. So you want to draw from the business. So in business account, you are drawing, let us say, some 20,000 or 2 lakhs. Okay, let us say 2 lakhs. You are drawing. Okay. So cash is going out. Cash is going out. Okay. So drawings. Drawings. If you take the accounting, drawing, there's a drawings is called drawings account. There's a account called by name drawings. So how will the drawings? You are by debiting drawings, you are taking the cash out. Okay. So there is a transaction between the two accounts. One is current accounts, one is non-current account. Clear? Okay. One is current account and another is non-current account. There is flow. In this case, it's outflow. So you are taking money for your daughter. Cash is remain the same here only. Cash remain the same. If you are not taking out, the cash will remain here. Now you are withdrawing for your daughter's marriage. Now you are taking 2 lakhs from this current account. Your current asset, current asset. You are taking 2 lakhs and 2 lakhs you are taking. How you are taking? You are taking to the debit of to the account debit of drawings account. Drawings account is a non-current asset. So transaction is between current asset, non-current asset. There is a flow. In this case, it is outflow. Got the point? Got the point? So the transaction, there is a transactions between year to year or year to year, there's flow of funds. Depending upon the nature of transaction, it may be outflow or inflow. Okay, I just told one example. So between when you're drawing it from the business, so cash is going out, is the current assets, which we want which account it has been debited, the drawings account. Drawings account and cash. So drawings is non-current asset. Okay, drawings is deducted from capital. Naturally, accounting system, it has been deducted from the capital. So it has reduced your capital. Do you understand? So this is a transaction between current and non-current. Year possible, year to year possible. Not even the same group. Okay. Supposing in this case, let us say group A. Group A, you want to buy a machinery. Oh, 2 lakhs, you bought a machinery. And the supplier says, I don't want any cash. Instead of giving the cash, you issue your company share. You issue a company share. So is there any funds flow? Nil. There's no any funds flow? Nil. So within the same group, there's no flow of funds. But it is interchangeable from A to B, B to A, transaction taking place, 2 accounts involving one current account, one non-current account. It results in flow of funds. To that extent, you stop, don't confuse yourselves. When I start explaining all this in the coming sessions, I will explain very clearly. So funds flow is very important. It goes inside into your working, nature of working, how the funds are moving, and so that they will come to know. The investors will find it very carefully, bankers will also find it very carefully, owners also will know whether there is any misappropriation or anything there, why it is not controlled, why this is going up, like that, all the things we can come to know. So very important. So now we have funds flow. We have got 3 stages are there. The one stage is first, working capital changes. Working capital changes means movements in this case. Movements in this case, the current assets and current liabilities. And then second is funds from operations. So net profit is a funds operation. Net loss is a use. Net profit is a source. Got the point? So there is the funds flow. There's we've got 2 sides of statement. One is sources. Sources means from where the money is coming, and then uses, how it is used. Sources, application. Sources, use. Sources, deployment. It's kind of simple. Where the money is coming, how is used. Where the money is coming, how is gone. Like that. So there is always these two should match. So it is not like a double entry system. For every debit, there is a credit like this. There's all the sources because between the sources only you have to spend. Within the sources only you have to buy raw materials. Within the sources only you have to, within the what loan amount taken, within the loan amount you have to build a machinery. So like that it will come. So the sources and the uses always tally because we are going under the double entry system. And one more thing, it is not on cash basis, it is on accrual basis. So we don't wait for the cash to come, the profit to come in cash. We assume that it will come at a later date, but we start working funds. You got the point? It is not on cash basis, it is on accrual basis because profit is a source. Profit movement, your profit and money has to go, some one day or other it is going to come back to you. Where it is lying? Where the profit is lying? Your profit is lying in the stock. Your profit lying in the book debts. The moment book debts are there, the moment stock is sold, profit will come back. As the money come, it will go to cash again. So it is on accrual basis, not on cash basis. You understand this? So very important. So try to see, and I hope you got the point. There are 2-3 aspects are there. I'll be explaining this to change in working capital. What is the change in the funds? Then what is the change in the funds from operations? Then you will work out a funds flow statement, bringing all the two into the account. Then you will arrive at the funds flow statement. After that, I am going to see to it that how you read the funds flow statement. Very important. How you read but that's more preparation is not very important. How to read the funds flow statement, very important. So I hope you got it from me. The inputs till we meet in the next session. All the best. Take care. Take care of you. Thank you.